Welcome everyone to this week's episode of The Real Estate Collective, brought to you by WFG National Title. I am your host, Lisa Suazo. I'm with WFG sister company, My Home. And I'm so excited today because I am joined by a very special guest, Matt Sandler, who is with our WFG family. He hails from Portland and he is on our legal side. He's the Vice President of Oregon State Counsel, Underwriter. Matt, I want to turn it over to you and just let our audience know a little bit about you and your background, because you're going to be helping us talk about FIRPTA today.
Sure. Thank you, Lisa. So first, it's a pleasure to be here and kind of going through these few interview questions and talking all about FIRPTA, one of my favorite topics. But to give you a little bit of my background and how I came to be sitting in front of you all today, I've been with WFG for a little over 8 years now. Time absolutely flies. Before I kind of started working with WFG, I was on the real estate finance side and I worked for a local lender here and was a real estate investment analyst for them for some time. I decided that law school or the legal side of real estate was still the route that I kind of wanted to go down. So left the lender, went to law school here in Portland at Lewis & Clark. It is in my first year of law school that I met WFG, and I started working for them part-time during the semesters, full-time during the summers. And while I was in law school, I also got my broker's license and helped investors buy and sell real estate, which was kind of a spin-off of the work that I did with the lender. Graduated law school. Upon graduating, WFG offered me a full-time position with them upon passing the bar, which I graciously accepted and have been with WFG really ever since. In addition to the work that I do with WFG, I have also been an adjunct law professor at Lewis & Clark teaching property transactions. I did that for about three years. And then right before the pandemic, I kind of paused that. Again, as I mentioned, have been kind of diving into WFG, I suppose, even more full time. And WFG has been really incredible as kind of exposing me to different facets of our industry. So I spent time as our underwriting counsel in the Pacific Northwest. I spent time as our national claims counsel. I spent time as our corporate counsel for our parent company, Williston Financial Group. I was a commercial closing attorney for some time as well, and have kind of made it full circle back to, as you mentioned in the very beginning, the underwriter and state counsel for Oregon. So it's been an awesome ride. I love this industry. I could not be more where I'm supposed to be. And so I like to share this kind of that backstory and this passion, because I really want you, all of our employees, clients, customers, whomever, to really use me as a resource and reach out if there's ever anything I can help with.
I love that. Thank you so much, Matt. I mean, you have such an incredible background and diverse skill set. And when I was actually asking our escrow manager, like, who is our best, expert on FIRPTA? Who should I talk to? She was like, oh, Matt is like the FIRPTA guru. So,
I will take that. I will take that nod. Yes, FIRPTA is definitely something that I deal with often, probably now on a weekly basis to a certain extent. We're just seeing a lot of FIRPTA related transactions. I think as our market has appreciated, a lot of these foreign investors are starting to offload some of their U.S. real estate holdings, and that, of course, implicates FIRPTA, and we're seeing more and more of that. So this is, again, a very timely, I think, conversation.
Wonderful. Well, then let's just kind of dive in. If you don't mind, Matt, I just want to start super basic. Can you just tell our audience exactly what is FIRPTA first?
That's a great place to start. So FIRPTA stands for the Foreign Investment in Real Property Tax Act. It was passed back in 1980. And really the reason for this legislation was back prior to FIRPTA being passed, there was concern from the federal government, and in particular the IRS, that foreigners were selling their US real property interests and then taking those gains and going back to their home country without paying any of the taxes or the gains on that sale of the asset or the real property. And so the IRS, I like to think of them as this hungry beast that constantly likes to be fed, and they like to be fed by way of money. And so they wanted to make sure that they were getting a piece of the pie, essentially, when the seller or when these foreigners or non-US citizens were selling their real property interest. We wanted to find a way to make sure that we were getting those taxes paid upon the sale. And so what the IRS did was they passed FIRPTA, and they basically made the buyer, as counterintuitive as this may seem, they made the buyer the one legally responsible to make sure that the applicable FIRPTA withholding is paid at the time of the closing. And the reason why they made the buyer the one that's legally responsible for this FIRPTA withholding is because, of course, the buyer, being the one that is purchasing the property, is likely to be in the US. So the United States has remedies or a course of action to go after the person that's in the US for the payment, but also, and more importantly, the real property is remaining in the United States. So the IRS has the ability to lien the property, et cetera, to make sure that they get paid. And it's obviously much harder for the US to go after a foreign seller when they're back in their home country. There's jurisdictional issues, of course, and it's much easier for the IRS to go after the buyer in the property for that payment of tax if it's not made by the seller at the time of closing.
Interesting. Okay. Thank you. So I have kind of a list of questions, I guess, that my escrow team tends to get often about FIRPTA.
Yes.
If you're cool with it, I'm going to just kind of roll through some of these FAQs.
Please.
Okay, awesome. So first question would be, how much is withheld for that?
The standard withholding amount is 15% of the sale price, unless an exception applies. Sometimes there's confusion with this because back in 2015 or prior to 2015, the standard withholding amount was 10%. However, in 2015, Congress passed the Protecting American Taxpayers from Tax Hikes Act, also known as the PATH Act. It's a mouthful, but basically Congress increased the standard withholding from 10% to 15%. So now, again, the new standard withholding amount, unless an exception applies, is 15%.
Okay, so standard withholding amount is 15%. The question, how would they get their money back? Right?
That's a great question. So I oftentimes really like stressing this point that just because a seller is subject to FIRPTA withholding, it does not mean that the seller may not get some or all of that money back. And even in some cases, they might even have to pay more. But most oftentimes, when FIRPTA withholding is paid, it does not mean that they might not get some or all of that back. And how they go about doing that is filing their subsequent tax return with the IRS. And so they will report the sale and they will report the withholding that they remitted to the IRS upon the closing. They will also go through all of their other tax situations, just like you and I file our US tax return every year. They do the same. They report the sale. And what the IRS will do is, part of our submission to the IRS for the amount of the withholding, we also send in a number of forms to the IRS. And one of those forms is the 8288A. And the IRS will stamp a copy of the 8288A and send it back to the seller for them to attach to their US tax return to obtain a credit for that withholding. So that's how that process kind of works in a nutshell. So
is FIRPTA based off of the sales price, or is it based off of the proceeds received at closing?
That's a great question. So it is based on the sale price. So we do not care whether we're paying off liens or prior deeds of trust or taxes or what have you, and the seller might only be getting back a few thousand, or maybe they don't get back anything with all of the payoffs. However, FIRPTA is not based on the actual proceeds that the seller walks away with at the time of the closing. FIRPTA is based on the sale price.
Sale price. Okay. Sale price. Good to know. Okay. So here's a question. What if one of the sellers is a US citizen and the other is not? What amount is to be collected? And then what is that based off of?
Great question. So if two or more foreign persons jointly transfer U.S. real estate, each transferor seller is credited with that portion of the amount withheld that is mutually agreed between them. So for example, let's say you and I I'm a non-US citizen, you're a US citizen, we both purchase a property together, and let's say we have some sort of agreement where I have a 60% interest in the property and you have a 40% interest in the property. Comes time for us to sell. If we have some agreement or something establishing our interest in the property, we'll go based off that. So in the scenario that I just gave you, when I sell the piece of property, or when we sell the piece of property, I stated that I have a 60% interest, you have a 40%. So my 60% interest in the property is going to be subject to FIRPTA withholding. Your 40% interest is not. And so in the most basic example, let's say we have a sale price of $100,000. I know there's an exclusion or an exception for that amount, but ignoring that for just a second, let's say the sale price is $100,000. I mentioned that I have a 60% interest, you have a 40%. So my sale price is $60,000. That's allocated to me. The sale price that's allocated to you is $40,000. And so all we do is we take the FIRPTA withholding, the 15%, we basically multiply that against my 60% or the 60,000, and that determines the withholding. What comes up even more often than that is the example where we have a husband and wife, and they both jointly own the real estate, and one of the spouses is foreign and the other spouse is not. So basically the same thing applies, except that the IRS treats husband and wife as having contributed 50% each. So if there's a foreign spouse and a non-foreign spouse, when they sell the property, we're going to assume that they're 50% interest holders each, and then the FIRPTA withholding will apply based on their respective interest. And I will tell, just kind of to close this loop, I had mentioned in the very beginning that we look to, what percent ownership we might have in the property. If we don't have any information on that, for example, if the deed is silent or we don't have some sort of separate written agreement establishing the ownership interest in the property, the default rule is 50-50. So going back to the example, husband and wife, sale price is $100,000. We assume each have contributed 50% each to the property, so that upon the sale, we treat 50,000 or half the sale price as allocated to each, and then the FIRPTA withholding will apply to that respective spouse's 50% interest.
Okay, that makes sense. So unless something was specified, if somebody is married or if there was not something specified, it's 50-50.
Exactly.
Okay.
Exactly.
Okay. Oh, thank you. That's super helpful. Okay. Another question that we tend to get is, can they just quit claim off the one seller that is not a U.S. citizen and then close without paying the FIRPTA tax?
This is probably one of the most common questions that I get. And what I like about this question is that it means people are paying attention and they're thinking of creative ways as to perhaps how to avoid this tax. And basically, my response to that question is no, you can't do that. That is generally or could be considered tax fraud, because the individual, the foreign person that is subject to FIRPTA, in the hypothetical that you stated, the foreign person would only be deeding that property for the purpose of avoiding the FIRPTA withholding. So the purpose of the transfer is simply to avoid the tax. That's a no-go, can be considered tax fraud, and basically throws out red flags to the IRS. And we do not want to be involved in that at all. And I then get the question, well, how does the IRS even know? They have a myriad of ways of knowing, but one thing that tips people off is closely recorded deeds to one another. And so if somebody were to examine, and if an IRS agent were to examine the real property records and they saw that a deed was recorded days or a week or something very close to the sale, it's kind of easy to put the two and two together. It looks like this transfer really wasn't a bona fide transfer. It was done to avoid the subsequent tax because we saw that the sale took place 5 days later or what have you. So long story short, no, that's a no-go.
That's a no-go. No tax fraud here. Okay.
No tax fraud.
All right. Thank you, Matt. That was great. Question: why do you need my buyer's social security number if this is a seller charge, specifically on a cash deal?
So another really good question. And this, again, kind of goes back to my point in the very beginning. The kind of counterintuitive nature of FIRPTA is that, yes, the seller does pay the FIRPTA withholding rate at the time of closing. However, as I mentioned, if for whatever reason that FIRPTA withholding amount is not paid, it is actually the buyer's responsibility. And so because the buyer is the one that is legally responsible for determining whether or not FIRPTA applies and for ultimately making the required payment to the IRS requires the identification of the buyer and their tax information, et cetera, to make sure that it is all properly reported.
Got it. Okay. Yeah, that makes sense. Okay. Last question for you from our group. What do I do if my seller doesn't have an ITIN?
Great question.
I don't know what an ITIN is, Matt.
Well, let's start there then.
Okay.
An ITIN stands for an individual taxpayer identification number, and it's essentially the social security number equivalent for a non-US citizen. And so these ITINs, or these individual tax identification numbers, are given to individuals who are non-US citizens in order for them to be able to report their tax and to file their subsequent tax returns, et cetera, and to get that credit for any FIRPTA withholding that might have been submitted. And so interesting things happen, I guess, when the seller does not have an ITIN, because again, an ITIN is generally needed in order for the seller to claim the credit for the withholding. And so the IRS gives us very clear guidelines as to what we're supposed to do in the case when a seller does not have one. And so in short, we would submit. So there's a couple of, I guess, different ways to address this. The first one is that we can submit the FIRPTA withholding without the seller's tax ID number. However, in order to do that, the escrow officer would actually need to complete this affidavit that we have on file that I would be happy to provide. But basically, the escrow officer completes an affidavit that includes the name and addresses of the seller, including a statement that the seller does not currently have an ITIN, but are either in the process of applying for one, or perhaps they refuse to apply for one. We've run into that situation before, but we set forth that in the affidavit, or the escrow officer does. And the escrow officer then needs to get the buyer's permission to proceed in closing without the seller's tax ID number, because again, it's the buyer that is ultimately liable for this. So we basically want to make sure everything is above board, everybody's fully aware of what's going on, and everybody kind of signs the appropriate instructions that we're submitting this FIRPTA withholding without the seller social security or tax ID number. And then we include very special instructions, or a special paragraph in our escrow instructions that basically states that the seller is acknowledging to us that they do not have a tax ID number, and that we are being instructed nevertheless to submit the withholding to the IRS just using the buyer's tax ID number. And the seller understands and acknowledges that they will not be able to obtain a refund or a credit for the FIRPTA withholding unless they apply and obtain a tax ID number. And so, kind of going back again to the very beginning of our conversation, and in my describing the IRS as this hungry beast that constantly likes to be fed, in this situation, the IRS is getting paid. We're submitting the full withholding amount to the IRS at the time of closing. So the IRS has gotten their 15%. So they're happy. However, the seller is not going to be able to get any of that back or claim any sort of credit if they don't file their taxes. And you can't file your taxes without a tax ID number. We make very clear the repercussions of that. We, strongly encourage the sellers to work with the CPA, because it's to be quite frank, it's fairly easy and straightforward to obtain a tax ID number. It can be done so fairly quickly as well. And so we'll often connect sellers to CPAs if needed, or really encourage them to talk with their own CPA as to how to go best about this.
About it. Have you ever seen situations where somebody like refuses completely, and then what happens?
In those situations, we really, want to make sure that we're documenting everything and we're making it very clear as to what I just shared, that, in order to claim a credit or to get a refund of these funds, you have to have a tax ID number in order to file your subsequent tax return and report that sale, et cetera. And so if they never do that, well, then they're out the 15% and they're just never going to get it back. We don't necessarily care, because our liability as the qualified substitute, which I know we haven't gotten into, but that's kind of our role in these FIRPTA transactions. And we've kind of fulfilled our obligations on behalf of the parties by remitting the appropriate amount to the IRS and, submitting all of the documentation per the IRS guidelines, et cetera. And so if a seller decides, I don't want those funds, I never intend to file a tax return, that's on them. The best we can do is encourage them to speak to a CPA and give them the information and whatnot that they need to ultimately make that decision. That's very, very rare, because of course 15% of 15% for the sale of a property can be a lot of money. And so that's often all of the encouragement a seller needs to go out there and get a tax ID number. Otherwise, they're just out that amount. And I will actually, you didn't ask me this exact question, but just to illustrate our role and to illustrate how important these tax ID numbers are, and also to perhaps give some sort of reassurance to these escrow officers, I want to give an example of when we closed a transaction where a seller had completed a certification of non-foreign status. And so this certification of non-foreign status, we have not talked about yet, but the certification of non-foreign status is probably the most important document in this FIRPTA discussion, because the certification of non-foreign status should be signed on every single transaction, every single sale transaction. I don't care if it's you're selling your mom's home and your mom is a US citizen, or your brother is selling, whatever the case is, we should be getting these certifications of non-foreign status on every single transaction. And what the certification of non-foreign status is it's basically a certification that the seller signs and states, I'm not a foreign person for purposes of FIRPTA. Here's my address, here's my tax ID number, and I'm certifying to you, buyer, under the penalties of perjury, I am not a foreign person, therefore FIRPTA does not apply. And that document, as stated by the IRS and the statutes pertaining to FIRPTA, that document is the only document that the buyer is able to rely on to insulate them from FIRPTA liability. And so I bring this up because we had a situation where a seller fraudulently completed the certification of non-foreign status and included a false social security number. None of the parties were aware that a fake social security number was being given. And I did not find this out until months after the transaction, that the seller had given us the wrong information. Long story short, however, because we had that certification of non-foreign status on file, the buyer nor the escrow officer or us, the escrow company, had any idea that what was being set forth was false. We were protected, and our buyer, did not run the risk of becoming liable because, again, we all had that certification of non-foreign status. And so I share that again to highlight and underscore just the importance of that certification of non-foreign status. And so what that means is, to kind of close this conversation, if we do not have a certification of non-foreign status on file, or the seller is unwilling to provide a certification of non-foreign status, we are to assume, or the buyer is to assume, that FIRPTA applies.
Huge.
I know that was a lot, but I hope.
No, I think that was really important because, yeah, it wasn't even on my list and it's hugely important. So thank you for sharing that, Matt. And I want to respect your time, but I would just say, let me throw the one last question out to you. Is there any other thing like this, the certification of non-foreign status that you mentioned, anything else regarding this FIRPTA conversation that you think it would be really important to mention before I let you go?
I have two things that I want to mention. So the first one is we have not really talked about in this short conversation, we have not really talked about who is considered a foreign person. And a foreign person, as defined by FIRPTA, includes the following: non-resident aliens, and a non-resident alien just means a non-US citizen, foreign corporations, foreign partnerships, foreign trusts, foreign estates, and single member LLCs. And I want to stress the single member LLC because this is a really important piece that I think most often gets overlooked. And so here's the typical example that I see where parties run into issues. We'll have so first and foremost, a single member LLC is generally considered a pass-through entity. So we look past, we kind of pierce the corporate veil and legalese, and we look past the LLC and we look at that individual who's behind the LLC. We look at that single member. And so what happens with that in the back of your mind, what happens is we have, let's say, a Canadian investor, developer who wants to invest and develop property in California, let's say. And so the developer or this Canadian investor will set up a single member LLC, a California domestic LLC for the purposes of holding title to the real property. And, this investor fixes it up and is ready to flip it, gets ready to sell, escrow's open. We go through all of our standard paperwork, the seller's having the conversation with the real estate broker, and kind of everybody sees, oh, the seller on this is a Californian LLC. So FIRPTA doesn't apply because we have a domestic California LLC that's the seller in our transaction. And so in those situations, if people aren't paying attention, I've seen on a number of occasions where we'll get very close to closing, escrows going through their processes and procedures and their checklists, and they know about the single member rule. And so on the 11th hour, they'll say, wait a second, we're reporting under the seller's individual name. The seller is Canadian, is not a US citizen. So actually FIRPTA does apply. And you can imagine how a seller might feel, and a buyer for that matter, but a seller might feel at the very 11th hour that we tell them, hey, actually your sale is subject to FIRPTA and we have to send 15% of the sale price to the IRS at closing. That's typically not a good conversation to have at the very last second. And so I really encourage escrow officers, when I give this class to real estate agents, to really pay attention when you have a single member LLC, even if it's a Colorado LLC or an Oregon LLC, if it's single member, again, we disregard the entity and we look past that and we look to the individual and whether or not FIRPTA applies to them. The other item that I want to mention is that we have what's called a withholding certificate, or the IRS has what's called a withholding certificate that the seller can use to apply to the IRS for a reduced withholding. So, for example, if we're having a lot of back and forth with the seller and the seller is adamant that no tax, no FIRPTA withholding should apply because of X, Y, and Z. Of course, we are not tax professionals. We're not providing tax advice. We're not agreeing or disagreeing with the seller's assertions. However, what the seller can do in those situations is there is the ability for the seller, through an application for withholding certificate, which is done on Form 8288B, the seller requests a reduced withholding from the IRS, and submits this certificate, and they have to do so at or before closing. And then within 90 days, according to the IRS, however, it's probably closer now to about 120 days or 150 days, just due to the backlog, is that the IRS will respond with a withholding certificate, basically stating what the applicable withholding rate is. So it could be a reduced withholding, or it could completely eliminate the withholding. And so that's often a strategy that, if it's brought up in the beginning of a transaction and this FIRPTA discussion is being had, there is an ability for the seller to explain ahead of time their tax situation, perhaps why there's going to be no gain on the sale or whatever, that they can use that mechanism to apply to the IRS for that reduced withholding. And if we get that back, as escrow can then rely on that withholding certificate as to our instruction as to what we're actually going to remit at the time of closing. So those are two additional items that I think are important to be aware of in this FIRPTA conversation.
Oh my gosh. Matt, thank you so much. This is like really interesting and quite enlightening, actually, for me too.
Good.
I really appreciate you sharing.
Oh, my pleasure. My pleasure. I love this stuff. So I encourage all of you, if any of this did not make sense, or if you have any follow-up questions, or you want to see a particular form, or if you have questions about any of the forms, again, always feel free to reach out to me and ask any questions.
Okay, awesome. Well, Matt, thank you again so much for your time today. And
my pleasure.
Really appreciate it. I am going to go ahead and say goodbye.
All right.